Did you know that Wall Street is making an extra $250,000 off your retirement account? I uncovered this shocking truth after spending 15 years in the financial industry, and what I found will change how you invest forever. While everyone's pushing index funds as the holy grail of investing, the wealthy are quietly using momentum strategies that have outperformed the market by 3% annually since 2000. That difference means an extra $250,000 on a typical retirement account. Today, I'm exposing the strategies don't want you to know about. The $250,000 gap, index funds versus momentum investing. What if I told you that two investors starting with identical $100,000 portfolios in 1990 would have a $250,000 difference by 2024 based on one simple strategy change? This isn't some get-rich-quick scheme or Wall Street fairy tale. It's the real-world power of momentum investing versus traditional index funds. Meet Sarah and Mike. They're both smart investors who started with the same amount back in 1990. Sarah followed the conventional wisdom. She put her money in S&P 500 index funds and let it ride. Mike took a different approach. He used momentum investing strategies that I'm going to break down for you today. Fast forward to 2024, and the difference between their portfolios is staggering. Sarah's index fund approach yielded about 7.6% annually, turning her $100,000 into approximately $1.1 million. Not bad at all. But Mike? His momentum strategy delivered over 11% annually, growing his identical starting amount to more than $1.35 million. That's a $250,000 difference from one simple strategy shift. Think about what that extra $250,000 means in real life. That's college education for grandchildren. That's upgrading your retirement lifestyle from budget-conscious to comfortable. That's working 5 fewer years before reaching your retirement number. Now, I know what you're thinking. Higher returns must mean higher risk, right? That's what Wall Street wants you to believe. But here's what's truly mind-blowing. Momentum strategies have historically delivered these superior returns with less downside risk during market crashes. Let's look at what happened during the 2008 financial crisis. When markets were in freefall, Sarah watched her S&P 500 index fund plummet by 51%. Half her money gone in 18 months. Meanwhile, Mike's momentum portfolio certainly took a hit, but limited losses to just 19%. That's less than half the damage. This protective effect isn't just a one-time fluke. During the 2020 COVID crash, the same pattern emerged. The S&P 500 dropped 34% in a matter of weeks, while properly executed momentum strategies limited losses to around 20 to 25%. That means recovering faster and getting back to making money sooner. The math behind this 3.4% annual performance gap is deceptively powerful. Most people hear 3.4% difference and think, that's nice, but not life-changing. This mindset costs investors hundreds of thousands of dollars over their investing lifetime. Here's why. Compound interest doesn't just grow your money, it magnifies the gap between different rates of return over time. In the first few years, the difference between Sarah and Mike's portfolios was minimal, maybe a few $1,000s. By year 10, the gap had grown to about $40,000. Not earth-shattering, but nothing to sneeze at either. But then something magical happened. As their portfolios grew larger, that percentage gap translated into increasingly bigger dollar amounts. By year 20, the difference had ballooned to over $100,000. And in the final years approaching retirement, the gap expanded even faster, eventually reaching that $250,000 chasm. This is the visualization I wish every investor could see. 2 lines on a chart, starting from the same point, with the gap between them growing exponentially wider as time passes. It's the perfect illustration of how seemingly small improvements compound into life-changing differences. But let's talk about what actually makes momentum investing work. At its core, the strategy is surprisingly straightforward. It's based on a simple principle that's been proven in dozens of academic studies. Stocks that have performed well recently tend to continue performing well in the near future. This isn't just true for individual stocks, it applies to entire sectors and asset classes too. Technology outperforming utilities? That trend often continues. small caps beating large caps, that momentum frequently persists for months or even years. The momentum effect exists because of how humans and institutions behave in markets. When positive news emerges about a company or sector, investors don't immediately price in all the implications. Instead, they gradually come to understand the full impact, creating a sustained uptrend rather than an immediate price jump. Mike's strategy took advantage of this by systematically identifying the strongest performing sectors and shifting his investments toward them. When healthcare was outperforming, he overweighted healthcare. When technology was leading the market, he increased his technology exposure. It's not about predicting which sectors will perform best. It's about recognizing which ones are already showing strength and riding that momentum. This sector rotation approach is particularly powerful during major market transitions. When the 2008 crisis hit, momentum signals began flashing red for financial stocks months before the worst of the crash. Investors like Mike, who followed these signals, reduced their exposure to financials and shifted to more defensive sectors like consumer staples and utilities. This single move alone saved them from devastating losses. Similarly, when markets began recovering in 2009, momentum strategies quickly identified emerging strength in technology and consumer discretionary sectors, allowing investors to capture the powerful upside of the new bull market while many index investors were still licking their wounds. The beauty of momentum investing is that it doesn't require predicting the future. You don't need to know what the Fed will do next, whether inflation will rise or fall, or which geopolitical crises might emerge. You simply need to identify which investments are already showing relative strength and systematically allocate your capital to them. And here's another advantage that Wall Street doesn't want you to know. Momentum strategies can be implemented with the same low-cost ETFs that have made index investing so popular. You don't need exotic derivatives, complex option strategies, or high-frequency trading algorithms. Simple sector ETFs, bought and sold through any standard brokerage account, are all the tools you need. Of course, there are nuances to implementing momentum strategies effectively. You need clear rules for identifying momentum, specific criteria for when to rotate between sectors, and disciplined risk management protocols. But these are all learnable skills, not mysterious secrets locked in a Wall Street vault. The evidence for momentum's effectiveness isn't just anecdotal. It's been extensively documented in peer-reviewed academic research. Studies from prestigious institutions like the University of Chicago and Yale have confirmed that momentum has been one of the most persistent and profitable market anomalies, working across different time periods, market conditions, and even across different countries and asset classes. What's truly remarkable is how few individual investors actually utilize momentum strategies despite their proven track record. Wall Street has done an incredible job convincing everyday investors that index funds are the only sensible option, while quietly using momentum and other factor-based approaches for their own proprietary trading. The hidden costs eating your index fund returns. While investment giants preach the gospel of low-cost index funds to everyday investors, they're keeping quiet about the invisible costs that could be stealing up to 10x more from your returns than the advertised expense ratio. Ever wonder why the same institutions pushing index funds don't exclusively use them for their own portfolios? We've all seen those appealing Schwab and Vanguard commercials boasting about index funds with rock-bottom expense ratios of just 0.2%. Just 2 pennies for every $100 invested, they proudly announce. It sounds like an incredible deal, right? Wall Street has masterfully marketed these products as the ultimate way for average investors to grow wealth without paying high fees. But here's what they're not telling you. That tiny expense ratio is just the visible tip of a very expensive iceberg that's silently draining your retirement funds. Let's pull back the curtain on what's really happening with your low-cost index fund. When you look at your statement, you see that microscopic expense ratio, but you don't see the 4 massive hidden costs that are quietly eating away at your returns. Transaction costs, tax inefficiencies, tracking error, and opportunity costs. First up are the transaction costs that come from index rebalancing. See, index funds aren't as passive as they claim. When companies enter or exit an index, your fund is forced to buy or sell regardless of whether it's a good time. This creates what I call the buy high, sell low problem. Exactly the opposite of successful investing. Remember that GameStop trading frenzy that made headlines? Your passive S&P 500 index fund had to sell GameStop shares at around $40 right before the price rocketed to $400. Then when GameStop eventually qualified for inclusion in the index, funds had to buy it at nearly $300 before it crashed back down. This isn't a rare occurrence. It happens regularly with index funds, creating a constant drag on your returns that never shows up in the expense ratio. The second hidden cost is tax inefficiency. Indexed funds frequently trigger forced capital gains distributions that create tax liabilities for you, even if you haven't sold a single share. When an index kicks out a company, your fund must sell it, potentially creating capital gains that get passed directly to you. Unlike professional investors who strategically harvest losses to offset gains, your index fund has no tax management strategy whatsoever. Think about what this means. You're paying taxes on gains that the fund decides to take, not when it's advantageous for your personal tax situation. For many investors, these unexpected tax bills can add another 0.3% to 0.7% in annual costs that never show up in that pretty expense ratio number. The third hidden cost is tracking error. Despite what fund companies advertise, index funds rarely match their benchmark indices perfectly. There's almost always a performance gap, which typically works against you. This tracking error might seem small, maybe 0.1% to 0.3% annually, but over decades of investing, it adds another layer of invisible costs eating away at your returns. Finally, there's the opportunity cost of being forced to own everything in an index, including companies that clearly show signs of trouble. When a company is clearly failing but still meets the criteria for index inclusion, your fund must keep holding it all the way down, while more agile investors can move to better opportunities. When you add up all these hidden costs, comprehensive research shows they typically reduce your returns by an additional 0.5%, 1.5% annually beyond the stated expense ratio. Let that sink in. The true cost of your index fund might be 5 to 10 times higher than what's advertised. What does this mean in real dollars? Let's say you're investing $500 a month for retirement over 30 years. With a traditionally expected 7% return, you'd have about $567,000 at retirement. But if these hidden costs are reducing your returns by just 1% annually, you'd end up with only $467,000. That's $100,000 less, all from costs that never appeared on any statement or disclosure. And that $100,000 loss is assuming modest contributions. For someone maxing out their 401k or with larger investment accounts, these hidden costs could easily strip away $250,000 or more from their retirement savings. That's money that could fund years of retirement, help your kids through college, or fulfill lifelong dreams. The worst part? Wall Street knows all about these hidden costs. The big banks and investment firms have entire departments dedicated to minimizing these exact same costs in their own portfolios. They've run the numbers and know precisely how much these invisible expenses are costing you. They just don't have any incentive to tell you about it. After all, the entire index fund industry is built on the promise of simplicity and low costs. Admitting that the true costs are much higher would undermine their marketing message. And with trillions of dollars flowing into these products, there's little motivation to be more transparent. What's particularly frustrating is that these same financial institutions use completely different approaches for their proprietary trading and high net worth clients. They employ strategies specifically designed to avoid these hidden costs while marketing simple index funds to everyday investors. This isn't a conspiracy theory, it's simple business economics. Index funds are incredibly profitable for the companies that offer them because they're easy to run, require minimal staff, and generate predictable fee income. Meanwhile, the hidden costs are borne entirely by you, the investor. Think about it this way. If index funds truly were the optimal investment approach, wouldn't the world's most sophisticated investors and hedge funds exclusively use them? Instead, they employ complex strategies to avoid precisely the problems we've just discussed. The reality is that while index funds have their place, they're not the perfect, nearly free investment vehicle they're marketed to be. Once you account for all the hidden costs, they start looking a lot less attractive compared to some alternative approaches. What Wall Street insiders actually do with their money. Ever wonder if the people selling you investment advice actually follow it themselves? After uncovering the hidden costs of index funds, here's something even more eye-opening. Financial professionals are recommending one strategy to their everyday clients while quietly employing something completely different for their own wealth. This isn't just speculation. It's backed by industry data showing an enormous disconnect between what they sell and what they personally use. When you walk into a typical financial advisor's office as an average investor, what do you hear? Keep it simple. Buy low-cost index funds. Stay the course. This advice has become so standardized, it's practically a script. Advisors smile reassuringly while setting you up with a basic portfolio of broad market index funds, emphasizing their low expense ratios and proven long-term results. But what happens when these same advisors close their office door and manage their personal portfolios? The picture changes dramatically. Industry research reveals that over 80% of financial professionals use active management strategies for their own investments, the very approaches they often discourage retail clients from pursuing. These professionals aren't just slightly deviating from what they recommend, they're implementing fundamentally different investment philosophies. This creates an awkward question. If index funds are truly the best approach for building wealth, why aren't the experts using them exclusively for their own money? The reality is that many financial professionals recognize something they don't openly share with everyday clients. Momentum investing and active rotation strategies can potentially deliver superior results, especially during market volatility. While preaching the buy and hold gospel to retail investors, these same professionals are actively adjusting their own portfolios based on market trends and sector momentum. This approach appears particularly prevalent in hedge funds and family offices that manage wealth for the ultra-rich. These sophisticated investors aren't content with simply matching market returns minus fees. Instead, they employ momentum strategies that have consistently outperformed passive indexing during market corrections. When markets start heading south, these professionals don't just ride it out. They adjust their allocations to minimize losses while positioning for the eventual recovery. The performance statistics tell a compelling story. During market corrections, active managers have outperformed passive funds in 21 out of 28 market downturns over the past 34 years. This cyclical pattern shows that while passive strategies might shine during extended bull markets, active approaches tend to excel during uncertainty and downturns, precisely when protection matters most. So why the double standard? Why recommend one approach while practicing another? It's not simply about deception. It's about access and profitability. The financial industry has created a two-tiered system where their most effective strategies remain exclusive and inaccessible to average investors. These institutional-grade investment approaches typically require minimum investments of $500,000 or more, effectively pricing out the vast majority of retail clients. By establishing these high barriers to entry, financial institutions can maintain exclusivity while extracting premium fees from wealthy clients. This creates a troubling reality where everyday investors are steered toward passive index funds that generate predictable, low-maintenance revenue for financial institutions, while more sophisticated and potentially more profitable strategies are reserved for the wealthy. As one industry insider bluntly put it, the financial industry creates an information asymmetry that keeps their best strategies exclusive while pushing index funds on everyone else. This information gap has serious consequences. While the average retail investor faithfully follows the buy and hold index funds mantra through every market cycle, institutional investors are actively managing their exposure based on changing market conditions. This contributes to a widening performance gap between everyday investors and financial insiders that compounds over decades. You might wonder if this performance difference is real or just marketing hype. The evidence suggests it's quite real. Institutional investors consistently achieve higher returns than retail investors, and their access to advanced strategies plays a significant role in this disparity. While some of this advantage comes from negotiating lower fees, much of it stems from employing more sophisticated investment approaches, particularly those that adapt to changing market conditions rather than blindly holding through downturns. Consider what happens during major market corrections. While passive index investors watch their portfolios plummet during recent crashes, many active managers were able to significantly reduce losses. This difference isn't just about preserving capital, it's about positioning for the recovery. When you lose less during downturns, you need less growth just to get back to break even, creating a mathematical advantage that compounds over time. The cyclical performance pattern between active and passive strategies also reveals an important truth. Different approaches work better during different market environments. While passive indexing has dominated during the extended bull market of the past decade, history shows that active management tends to shine during periods of volatility and transition. Precisely the kind of environment many economists believe we're entering now. This creates a particularly troubling scenario for retail investors who have been conditioned to believe that index funds are always the superior choice. By the time the market environment shifts to favor active approaches, most everyday investors will have missed the opportunity to protect their wealth. None of this means index funds are inherently bad investments. They provide broad diversification, low headline costs, and require minimal maintenance, all valuable features for busy people who don't want to actively manage their investments. But the blanket recommendation that they are always the optimal choice regardless of market conditions or investor circumstances? That's where the financial industry's advice diverges from its own practices. Momentum investing, which institutional investors frequently employ, follows a straightforward principle. Assets that have performed well recently tend to continue performing well in the near future. This phenomenon has been extensively documented in financial research, yet it remains curiously absent from most financial advice given to retail investors. Instead of encouraging everyday investors to consider incorporating some momentum strategies into their portfolios, financial advisors typically steer them exclusively toward passive approaches. This disparity becomes even more troubling when you consider that many financial advisors are genuinely trying to help their clients. The problem isn't individual malice, but rather a system designed to maximize profitability by keeping certain strategies exclusive while standardizing advice for the masses. It's simply more efficient to recommend the same passive approach to everyone below a certain wealth threshold. The HNI Wealth Builder, 30% annual returns revealed. What if you could access the same powerful strategies the wealthy use? Let me introduce you to something that'll make your index fund returns look like spare change. While Wall Street keeps telling you to settle for single-digit gains, there's a real-world strategy that's been quietly generating returns that seem almost fictional. But I assure you, they're 100% real. The HNI Wealth Builder momentum strategy isn't just slightly outperforming the market, it's absolutely demolishing it with a jaw-dropping 30% compound annual growth rate since 2016. That's not a typo. 30% every year. Let that sink in for a moment. While most investors celebrated their impressive 10% index returns, this strategy tripled those results year after year. I can almost hear you thinking, yeah, right, show me the proof. Fair enough, let's look at the actual portfolio. The current HNI Wealth Builder consists of 44 carefully selected stocks, and the performance numbers are genuinely mind-blowing. The top performer in this portfolio has skyrocketed by 258%. Not over decades. We're talking about recent performance that makes standard investment advice look absurdly conservative. But that's just the beginning. 14 stocks in this portfolio have gained over 100%. While your financial advisor might tell you that doubling your money is an unrealistic expectation, this strategy has 14 different positions that have done exactly that. We're not talking about cherry-picking a single lucky investment. This is systematic outperformance across multiple holdings. The closed transaction record tells an even more impressive story. Let me share some specific examples that'll make your head spin. There's Tanla, which delivered an astounding 811% gain. Yes, you read that correctly, a single stock that multiplied the initial investment by more than 9 times. Then there's alkylamine with a 462% return and graphite with a 411% gain. These aren't penny stocks or crypto gambles. These are legitimate companies selected through a disciplined momentum approach. Now you might be wondering, what's the catch? Surely there must be enormous risks to generate these kinds of returns. This is where things get really interesting. The HNI Wealth Builder strategy actually loses money on 54% of its trades. That's right, more than half of the trades are losers. But here's the secret. The winners are dramatically bigger than the losers. The average gain on winning trades is 53%, while the average loss on losing trades is only 11.4%. This is professional-grade risk management in action. By cutting losses quickly and letting winners run, the strategy produces exceptional returns even with a win rate below 50%. This flies in the face of conventional wisdom that says you need to be right most of the time to make money in the market. This disciplined approach to risk management is what separates amateur investors from professionals. The ability to admit when you're wrong and exit a position with a small loss, rather than hoping it comes back, is psychologically difficult but mathematically powerful. When combined with the patience to let profitable positions continue growing, it creates a mathematical edge that compounds over time. Think about what this means in practical terms. If you start with $100,000 and earn the 30% annual returns this strategy has delivered, you'd have over $370,000 after just 6 years. Meanwhile, an index fund investor earning 10% would have only about $177,000. That's a difference of nearly $200,000, not from investing for decades, but from just 6 years of implementing a superior strategy. What makes this even more remarkable is that the strategy doesn't require complex derivatives, option strategies, or leveraged bets. It's fundamentally about identifying stocks with strong momentum characteristics and managing them with discipline. The approach is straightforward. Buy stocks that are already moving higher, not trying to catch falling knives. Set clear exit points to protect capital, and let winners continue running until momentum fades. This isn't just theory or back-tested results. These are actual returns from a real-world strategy that's been hiding in plain sight. While financial publications debate whether passive or active investing is better, sophisticated investors have been quietly implementing momentum approaches that outperform both. The key insight here is understanding why momentum works as a strategy. When a company reports strong earnings, introduces innovative products, or gains market share, these positive developments don't get fully priced into the stock immediately. Instead, they create a sustained trend as more investors gradually recognize the improving fundamentals. By systematically identifying and riding these trends, momentum investors capture outsized returns. And, unlike some complex investment approaches, momentum strategies can be implemented with reasonable time commitments. The HNI Wealth Builder doesn't require day trading or constant monitoring. Its success comes from systematic selection criteria and disciplined execution, not from frantically jumping in and out of positions. The strategy's results demonstrate something crucial that Wall Street doesn't want everyday investors to realize. Market-beating returns aren't just possible, they're achievable with the right approach. The financial industry has a vested interest in promoting the narrative that beating the market is impossible, which conveniently justifies selling passive products with guaranteed mediocrity. What's particularly interesting is how this strategy performs during different market conditions. While an index fund forces you to ride the full market roller coaster, momentum strategies like the HNI Wealth Builder can adapt to changing conditions. When the broader market weakens, momentum typically begins to fade in affected sectors, triggering exits before major damage occurs. This is why momentum investors often avoid the worst of market crashes. Their systematic approach forces them to respect deteriorating conditions rather than hoping things will improve. It's not about predicting the future. It's about reacting systematically to what the market is actually doing right now. The implications of these results are profound. If a 30% annual return is achievable with a disciplined momentum approach, why would anyone settle for the single-digit returns of index funds? The answer lies in what we discussed earlier. The financial industry's incentives aren't aligned with maximizing your returns. It's more profitable to keep sophisticated strategies exclusive while selling simple products to the masses. But now you know better. You've seen what's possible when you implement professional-grade investment techniques. The HNI Wealth Builder isn't some theoretical concept. It's a real strategy with documented results that demonstrate how a disciplined momentum approach, combined with proper risk management, can yield returns that make traditional index funds look painfully inadequate. Momentum investing, the science behind market-beating returns. The spectacular results of momentum investing aren't just lucky flukes. They're backed by decades of academic research that most traditional financial advisors never discuss with their clients. While the efficient market hypothesis claims that consistently beating the market should be impossible, momentum investing has quietly been disproving this theory year after year. Let's get real about what makes momentum so powerful. At its core, momentum investing is beautifully simple. Stocks that have performed well recently tend to continue performing well in the near future. This flies directly in the face of traditional finance theory, which suggests markets are efficient and that no strategy should consistently outperform over time. Yet here we are, with momentum strategies repeatedly crushing market averages. What's particularly fascinating is how momentum has dominated other investment factors. In 2024, momentum ranked as the best performing factor across U.S. markets, developed markets outside the U.S., and emerging markets. And this wasn't just a one-time fluke. It's happened 4 times in the past 20 years. The numbers don't lie. U.S. momentum's rolling 12-month excess return compared to the S&P 500 is now sitting in the 96th percentile over the past 50 years. That's not just good, that's historically exceptional performance. But why does momentum work so consistently when we've all been told beating the market is nearly impossible? The answer lies in human psychology. Our brains are wired in ways that create predictable patterns in financial markets. Think about investor herding behavior. When people see others making money on certain stocks, they naturally want to join in. This creates a self-reinforcing cycle where buying begets more buying. Then there's underreaction to positive news. When companies announce better than expected earnings or breakthrough innovations, investors don't immediately price in the full impact. Instead, this positive information slowly filters through the market over weeks or months, creating sustained uptrends that momentum strategies can capture. It's like watching a wave form. If you know what to look for, you can position yourself perfectly to ride it. Confirmation bias also plays a huge role. Once investors buy a stock, they tend to seek out information that confirms their decision was correct and ignore contradictory evidence. This leads to price trends that persist longer than they logically should, creating opportunities for momentum-focused investors to profit. What's particularly interesting about momentum's performance in 2024 is that it was driven by high-quality companies with consistent profitability. This marks a shift from previous momentum trends that often included more speculative stocks. The market is rewarding substance over hype, which creates more sustainable momentum trends with less downside risk. Understanding momentum requires recognizing its 2 distinct flavors, relative momentum and absolute momentum. Relative momentum involves comparing different sectors or stocks against each other to identify the strongest performers. Think of it as ranking all the runners in a race to find who's moving fastest. Absolute momentum, on the other hand, measures whether those sectors or stocks are trending upward compared to cash or treasury bills. This second filter helps avoid falling knives, stocks that may look strong compared to other terrible performers but are still heading downward overall. When you combine these 2 approaches, you get a powerful system for identifying the best investment opportunities while avoiding dangerous markets. This dual momentum approach has proven remarkably effective at capturing upside while limiting drawdowns during market corrections. The efficient market hypothesis suggests these patterns shouldn't exist or should quickly disappear once discovered. but momentum has remained persistently profitable for decades, even after becoming widely known in academic circles. In fact, the research community has been documenting momentum's effectiveness since the early 1990s, yet it continues to work year after year. Why? Because knowing about momentum isn't enough. You need the discipline to actually implement it systematically. Most investors can't overcome their emotional biases to stick with momentum through its inevitable periods of underperformance. They jump ship at precisely the wrong time, then jump back in after momentum has already reasserted itself. This behavioral gap between knowing and doing creates a persistent opportunity for disciplined investors who can stick with the strategy. The investment world is filled with factors that have shown promise in backtests but fizzle in real-world application. Momentum stands apart. It's worked across virtually every market and time period tested. It's worked in U.S. stocks, international stocks, emerging markets, bonds, commodities, currencies, you name it. This universal effectiveness suggests momentum is tapping into something fundamental about market behavior, rather than being a statistical fluke or data mining artifact. What makes momentum particularly attractive is that it tends to perform well when other factors struggle. Value investing, for instance, often suffers during momentum's strongest periods, creating a natural diversification benefit when you include both in your portfolio. This non-correlation with other strategies means momentum can improve your overall risk-adjusted returns, even if you only allocate a portion of your portfolio to it. There's another reason Wall Street doesn't talk much about momentum. It contradicts the passive investing narrative that's become so profitable for major financial institutions. If investors realized they could systematically outperform with relatively simple momentum rules, billions would flow out of high-fee managed products and low-cost but underperforming index funds alike. The evidence for momentum's effectiveness is overwhelming. It's not just a theoretical concept. It's a practical strategy that's been implemented successfully by some of the world's most sophisticated investors. Renaissance Technologies, AQR Capital, and countless hedge funds have built billion-dollar businesses by incorporating momentum signals into their investment process. They know what works, and they're happy to let retail investors stick with index funds while they generate superior returns. But here's the thing. You don't need a supercomputer or a PhD in finance to implement momentum strategies. The principles are straightforward enough that anyone with basic investment knowledge can apply them. You just need to know where to look for momentum signals and have the discipline to follow them consistently. Sector rotation. Timing your investments for maximum returns. Those simple momentum principles become truly game-changing when you apply them across entire market sectors. While most investors are debating whether to buy or sell individual stocks, professional money managers are quietly shifting billions between sectors like technology, healthcare, and utilities based on predictable market cycles that repeat over and over again. Let me show you why this matters so much. In any given year, the difference between the best and worst performing sectors can exceed 40%. Think about that for a second. While the overall market might be grinding out an 8% gain, specific sectors are absolutely exploding with growth that you're completely missing if you're just sitting in a total market index fund. This performance gap creates a massive opportunity for investors willing to follow the money. Sector rotation is essentially a systematic approach to moving your investments between different market sectors based on which ones are showing the strongest momentum signals at any given time. The beauty of sector rotation is that it works because the market naturally moves through predictable cycles. During economic expansions, cyclical sectors like technology and consumer discretionary tend to outperform. When the economy slows, defensive sectors like utilities and consumer staples typically take the leadership position. Rather than trying to predict these shifts ahead of time, which is nearly impossible, momentum investors simply observe which sectors are already showing strength and position themselves accordingly. This strategy proved especially powerful during the 2020 pandemic crash. While the broader market was in free fall, investors using sector rotation strategies were able to quickly shift into defensive sectors like utilities and consumer staples, which significantly outperformed during the initial downturn. Then, as the recovery began, these same investors rotated back into growth-oriented sectors that led the market higher. This ability to adapt to changing conditions is what makes sector rotation so effective in both bull and bear markets. So, how exactly do you implement a sector rotation strategy? Let me walk you through a straightforward 5-step process that anyone can follow. First, calculate momentum signals for each sector using average returns over multiple timeframes. You might look at 3-month, 6-month, and 12-month performance to get a complete picture of each sector's momentum. Second, rank all the sectors based on their relative momentum. This simply means putting them in order from strongest to weakest performance. Third, check for absolute momentum to ensure the top-ranked sectors are actually trending upward compared to cash or treasuries. This critical step helps you avoid falling knives, sectors that might look better than others but are still trending downward. Fourth, size your positions equally among the top-ranked sectors. Most sector rotation strategies focus on the top 2-3 sectors to maximize returns while maintaining some diversification. Finally, establish clear exit rules. You'll want to exit positions if they fall out of the top rankings or if their momentum dips below cash. This disciplined approach to selling is what allows sector rotation to protect you during market downturns. The technical indicators that make this possible are surprisingly straightforward. Moving averages help identify the overall trend direction for each sector. When a sector's price is above its 200-day moving average, it's generally in an uptrend. Relative strength indicators compare each sector's performance to the broader market, highlighting which sectors are outperforming and which are lagging. What makes sector rotation particularly appealing is that you don't need to pick individual stocks to implement it. Exchange-traded funds, ETFs like the Select Sector SPDRs, give you instant exposure to entire sectors with a single purchase. There's an ETF for every major sector: technology, XLK, healthcare, XLV, financials, XLF, and so on. This makes sector rotation accessible to anyone with a standard brokerage account. Let's look at how this played out during the pandemic market crash of 2020 to see the strategy in action. As COVID fears intensified in February of that year, momentum signals began flashing warning signs for cyclical sectors like energy and financials. Investors following the sector rotation playbook would have shifted into defensive sectors like utilities and consumer staples. When these defensive sectors also began breaking down in March, absolute momentum turned negative across the board, signaling it was time to move to cash or short-term treasuries. This move alone would have helped investors avoid the worst of the downturn. Then, as the market began recovering in April, technology and communication services showed the strongest momentum signals, guiding investors back into the exact sectors that would lead the recovery. The performance difference between this active approach and simply holding through the crash was dramatic. While the broader market dropped over 30% during the worst of the sell-off, investors who rotated to defensive sectors and then to cash experienced significantly smaller drawdowns. And because they were systematically following momentum signals rather than emotion, they were able to get back into the market at the right time to capture the recovery. What's especially powerful about sector rotation is that it works in all types of market environments. During steady bull markets, it helps you concentrate in the strongest performing sectors. During volatile sideways markets, it helps you find pockets of strength even when the overall market is going nowhere. And during bear markets, it provides a systematic way to reduce risk and preserve capital. The cyclical nature of market performance means that sector rotation strategies can adapt to changing economic conditions, allowing you to shift into sectors that are likely to outperform based on current market dynamics. This adaptability gives you a significant edge over static investment approaches that maintain the same allocation regardless of market conditions. One important point to remember is that sector rotation isn't about predicting which sectors will perform well in the future. It's about observing which sectors are already exhibiting strong momentum and positioning yourself accordingly. This evidence-based approach removes the guesswork and emotional decision-making that plagues most investors. By following the momentum signals between sectors, you're essentially letting the market tell you where to invest, rather than trying to outsmart it with predictions or forecasts. This humble approach consistently outperforms over time because it aligns with how markets actually work, rather than how we think they should work. Risk management frameworks. How the wealthy protect their money. Now that you understand how to capture upside with momentum strategies, let's tackle the question that keeps wealthy investors up at night. How do I protect what I've already built? The difference between amateur and professional investors isn't just how they make money, it's how they avoid losing it. You might be surprised to learn that ultra-wealthy investors obsess more over preservation than growth. While the rest of us chase higher returns, they're implementing sophisticated risk management frameworks that minimize losses without sacrificing performance. This fundamental shift in perspective explains why the wealthy experience dramatically smaller losses during market crashes while still achieving superior long-term returns. When we talk about risk in investing, there's a massive disconnect between what you've probably been taught and how professionals actually think about it. The conventional wisdom taught to retail investors defines risk as volatility, those ups and downs in your portfolio that make your stomach churn. But here's the truth. Professional investors couldn't care less about short-term fluctuations. Instead, they view risk through an entirely different lens, as the potential for permanent loss of capital. This distinction is crucial. A temporary dip in your portfolio value isn't a problem if it rebounds. What professionals fear is money that's gone forever. The kind of losses that force you to sell at the bottom or investments that never recover their value. This brings us to a critical concept called drawdown, the maximum percentage your portfolio drops from its peak to its lowest point before recovering. Think of it as the worst-case scenario you might experience while holding an investment. The larger the drawdown, the more likely you are to panic sell at the worst possible moment, which turns a temporary loss into a permanent one. Here's why this matters. While traditional index funds have historically suffered massive drawdowns of 45 to 51% during major market crashes, properly implemented momentum strategies with risk management frameworks have limited those same drawdowns to just 22%. Imagine losing less than half as much during market catastrophes. That's the power of professional risk management. So what exactly does this professional-grade risk management framework look like? It consists of 4 essential components that work together to shield your wealth from devastating losses. The first component is position sizing, determining exactly how much of your money to allocate to each investment. Most retail investors make the critical mistake of allocating fixed dollar amounts or percentages without considering the risk characteristics of each position. Professional investors, however, use sophisticated position sizing methodologies that account for an asset's volatility, correlation with other holdings, and potential downside. For example, rather than simply putting 5% of your portfolio in every position, you might allocate only 2% to highly volatile assets while giving 8% to more stable ones. This ensures that riskier investments can't sink your entire portfolio if things go wrong. The key principle here is that higher risk positions receive smaller allocations, creating a natural hedge against catastrophic loss. The second component is correlation analysis, understanding how different assets move in relation to one another. When markets crash, many investments that seemed unrelated suddenly start moving in lockstep, making diversification useless when you need it most. Professional investors meticulously analyze these correlation patterns to ensure their portfolio doesn't fall apart during stress periods. By combining assets with low or negative correlations, you create a portfolio where something is always working, regardless of market conditions. This doesn't mean simply owning stocks and bonds. It means finding truly uncorrelated assets across different sectors, geographies, and even alternative investments that respond differently to economic changes. The third component is drawdown control, implementing mechanical rules that automatically reduce your exposure when markets turn dangerous. These aren't emotional decisions based on fear. They're systematic triggers that protect your capital during turbulent times. One effective approach involves setting predetermined exit points for your investments. If a position drops by a specific percentage, perhaps 7 to 10%, you automatically reduce your exposure. If the broader market breaks important technical levels, like falling below its 200-day moving average, You might shift a portion of your portfolio to cash or defensive assets. These rules prevent small losses from becoming catastrophic ones. The fourth component is tail risk hedging, protection against those black swan events that seem unlikely but would be devastating if they occurred. Rather than hoping these extreme market events never happen, professional investors allocate a small portion of their portfolio to instruments that actually profit from market chaos. This might involve purchasing put options that increase in value when markets crash, allocating to manage futures strategies that can go short during downturns, or maintaining a strategic cash reserve that can be deployed when others are forced to sell at fire sale prices. Think of tail risk hedging as portfolio insurance. You pay a small premium to protect against catastrophic losses. When implemented together, these four components create a robust risk management framework that dramatically improves your investment experience. But there's another professional approach that takes this even further: risk parity portfolio construction. Unlike traditional portfolios that balance dollar amounts, like 60% stocks, 40% bonds, risk parity balances risk contributions. Since stocks are typically 3 to 4 times more volatile than bonds, a traditional 60-40 portfolio actually has about 90% of its risk coming from stocks. Risk parity corrects this imbalance by allocating capital based on risk rather than dollars. This means investing more in lower-risk assets and less in higher-risk ones, creating a more balanced exposure to different market environments. When implemented properly, risk parity provides more stable returns across different economic scenarios, whether we're facing inflation, deflation, growth, or recession. The final piece of professional risk management involves setting up systematic risk triggers that automatically adjust your exposure based on market conditions. These triggers might include momentum breakdowns when uptrends reverse, volatility spikes above historical norms, deterioration in economic indicators, excessive valuation metrics, unusual correlation patterns between assets. When these warning signs appear, your pre-established rules might dictate reducing equity exposure, increasing cash positions, or rotating to defensive sectors. The key is having these decisions planned in advance, removing emotional reactions during stressful market periods. What makes this approach so powerful is that it doesn't rely on predictions. You're not trying to forecast the next market crash. You're simply responding to objective data as market conditions change. This systematic approach removes the guesswork and emotion that typically lead to poor investment decisions. The results speak for themselves. Investors who implement professional risk management frameworks typically experience 40 to 50% smaller drawdowns during market crashes while maintaining similar or better long-term returns. This dramatically improves the compounding effect that builds wealth over time. Remember, losing 50% requires a 100% gain just to break even, but losing only 20% requires just a 25% gain to recover. By focusing first on avoiding large losses, tax optimization, the six-figure wealth preservation strategy. While protecting your portfolio from market crashes is crucial, there's another wealth destroyer that operates in plain sight: taxes. The wealthy aren't just better at minimizing losses during downturns, they're masters at keeping the IRS from taking their hard-earned returns. What if I told you that the difference between amateur and professional investors could be worth another $100,000 in your pocket? That's right. Most investors are leaving six figures on the table through poor tax management. When we talk about investment costs eating away at your returns, we typically focus on expense ratios and hidden fees. But here's the shocking truth: taxes can be an even bigger drag on your investment performance than all those costs combined. And the worst part? Even investors who consider themselves financially savvy are bleeding money through taxes they could legally avoid. Tax optimization isn't about finding sketchy loopholes. It's about using legitimate strategies that the tax code specifically allows for. Yet most people aren't taking advantage of these opportunities. Let me break down the 5 key tax strategies that wealthy investors use to keep more of their money working for them instead of Uncle Sam. First, tax loss harvesting. This powerful technique involves strategically selling investments that have declined in value to offset the gains from your winners. For example, If you have a stock that's up $10,000 and another that's down $10,000, selling both would create a wash for tax purposes, saving you potentially thousands in capital gains taxes that year. The beauty of tax loss harvesting is that market corrections become opportunities. While other investors are panicking during a 15% market drop, savvy investors are harvesting those losses to offset future gains, creating a tax asset they can use for years to come. And after capturing the loss, you can reinvest in a similar, but not identical, investment to maintain your market exposure while still preserving the tax benefit. The second strategy is asset location, not to be confused with asset allocation. This approach is all about where you hold your investments, not just what you own. The framework is straightforward but powerful. Place tax-inefficient investments like bonds or REITs in tax-advantaged accounts like IRAs and 401ks, while keeping tax-efficient investments like growth stocks and index funds in your taxable accounts. Why does this work? Because investments like bonds generate income that's taxed at ordinary income rates, as high as 37% for high earners. By housing these in tax-advantaged accounts, you shield that income from immediate taxation. Meanwhile, long-term growth stocks can benefit from lower capital gains rates and tax deferral when held in taxable accounts. When implemented correctly, proper asset location can boost your after-tax returns by 0.25% to 0.75% annually without changing your investment mix or taking on additional risk. That's free money most investors are leaving on the table. The third strategy is tax-efficient fund selection. Not all funds are created equal when it comes to tax efficiency. Index funds are generally more tax efficient than actively managed funds, but even among index funds, there are major differences in how they're managed for tax purposes. For example, some index funds are forced to distribute capital gains when they rebalance or when investors redeem shares, creating taxable events for all shareholders, even those who haven't sold a single share. These forced capital gains distributions can be a nasty surprise at tax time. Instead, look for funds specifically designed with tax efficiency in mind. These funds use techniques like strategic lot selection when selling securities and minimal portfolio turnover to reduce taxable distributions. Some ETFs take this even further, with in-kind redemption mechanisms that further minimize capital gains. The fourth strategy is gain-loss pairing. This goes beyond basic tax loss harvesting by strategically matching the character and timing of your gains and losses. For instance, short-term losses are more valuable because they offset short-term gains, which are taxed at higher ordinary income rates. Smart investors keep a running inventory of their tax lots and strategically select which positions to sell based on their tax characteristics, not just their investment merit. This approach allows you to control exactly when and how you realize investment gains and losses throughout the year. The fifth strategy is charitable giving optimization. If you're charitably inclined, donating appreciated securities instead of cash can create a double tax benefit. You'll receive the same charitable deduction you would get from a cash donation, but you'll also completely avoid paying capital gains tax on those appreciated shares. For example, if you have $10,000 in stock with a $5,000 cost basis and donate it directly to charity, you get a $10,000 deduction and completely avoid paying capital gains tax on the $5,000 gain. Had you sold the stock first and donated cash, you'd owe capital gains tax on that $5,000 profit. For larger donations, consider a donor-advised fund, which allows you to make a large contribution in a high-income year, get the immediate tax deduction, and then distribute the money to charities over time. Now, let's talk about how much these strategies are actually worth. Remember that $100,000 figure I mentioned earlier? That's not an exaggeration. A typical retirement account managed with poor tax practices versus one optimized for taxes can easily see a six-figure difference over a 30-year period. Let's run the numbers. If tax drag reduces your returns by just 1% annually, a conservative estimate for many investors, a $500,000 portfolio growing at 8% would be worth about $4.5 million after 30 years. The same portfolio growing at 7% after tax drag would be worth only $3.8 million, a difference of $700,000. even with smaller portfolios, the impact is substantial. A $100,000 investment would grow to $906,000 versus $761,000 over the same period, a $145,000 difference just from better tax management. What makes this especially powerful is that tax savings compound just like investment returns. Every dollar you don't pay in taxes is another dollar working for you year after year. It's like getting a bonus investment return without taking on any additional risk. And here's something few advisors will tell you. Index funds can actually create serious tax inefficiencies through those forced capital gains distributions I mentioned earlier. When an index rebalances, funds are forced to sell securities that no longer meet the index criteria, potentially triggering capital gains that get passed on to you, even if you haven't sold a single share. This problem became particularly acute during the pandemic market volatility, and again during the tech sector rotation of 2023. Many investors in index funds were shocked to receive large capital gains distributions, despite their funds having mediocre or even negative performance that year. The good news is that implementing these tax strategies doesn't require exotic investments or complicated setups. Most can be done with widely available investment vehicles and a bit of thoughtful planning. The key is understanding how taxes impact your specific situation and being proactive rather than reactive. Remember, it's not what you earn that matters. It's what you keep after taxes, inflation, and fees. By focusing first on keeping more of what you earn through smart tax management, you're effectively giving yourself a pay raise without changing your investment strategy or taking on more risk. The psychology of successful investing, overcoming your biggest enemy. We've covered crashes, taxes, and all the external threats to your wealth, but now it's time to address the elephant in the room. You. What if the real reason most investors fail isn't market volatility or hidden fees, but the psychological traps hardwired into your decision-making process? Look, I'll be blunt. Your brain is probably sabotaging your investments. And you're not alone. The most sophisticated hedge fund managers and Wall Street veterans struggle with the same psychological battles you do. The difference? They've built systems to protect themselves from themselves. Let's put this in perspective. You can implement every strategy we've discussed so far, momentum investing, sector rotation, tax optimization, but if you can't control your emotional responses to market fluctuations, none of it will matter. Your own psychology will wipe out all those potential gains. The numbers are shocking. According to behavioral finance expert Dr. Daniel Crosby, the average investor underperforms their own investments by 3 to 5% annually. Think about that for a second. It's not that your investments are performing poorly, it's that your behavior is causing you to get substantially less than what your investments actually return. How is that even possible? The answer lies in poor timing decisions driven by emotion. Imagine buying a fund that returns 10% over the year, but because you got scared during a temporary dip and sold, then bought back in higher, your personal return might only be 6%. The fund performed great, but you didn't capture that performance. Let's break down the 5 most destructive behavioral biases that are likely costing you money right now. First, loss aversion. Our brains are wired to feel losses about twice as intensely as gains of the same magnitude. During market downturns, this biological response triggers an overwhelming urge to sell to avoid further pain. It's why so many investors panic sell at the bottom of a correction by locking in permanent losses instead of riding out the volatility. Your instincts scream, "Get out now," precisely when you should be holding steady or even buying more. Second, recency bias. We tend to overweight recent events when making predictions about the future. When markets have been rising steadily, we convince ourselves they'll continue forever. When they've been falling, we become certain a crash is imminent. This explains why money floods into funds that have recently performed well, only to flow out when those same investments inevitably cool off. Third, confirmation bias leads us to seek information that supports our existing beliefs while ignoring contradictory evidence. If you've decided a particular stock is a good investment, you'll likely focus on positive news about the company while dismissing negative developments. This selective perception creates dangerous blind spots in your decision-making process. Fourth, herding behavior pushes us to follow the crowd. When everyone around you is piling into the latest hot stock or cryptocurrency, it triggers a primal FOMO response that overrides rational analysis. Remember when your neighbor couldn't stop talking about buying GameStop at $300? That's herding in action. Finally, overconfidence bias leads investors to overestimate their knowledge and ability to predict market movements. Studies show that the more confident investors are in their predictions, the more likely they are to underperform. This false confidence leads to excessive trading, concentration in high-risk positions, and failure to diversify properly. The cruel irony is that these biases worked great for our ancestors in the African savanna. Quick emotional decisions kept them alive when facing predators. But in modern financial markets, those same instincts are precisely what destroy wealth. So how do we overcome these hardwired responses? The answer isn't willpower. Trying to overpower these biases through sheer mental discipline is like trying to hold your breath indefinitely. You might last a while, but eventually biology wins. Instead, successful investors create systems that make it impossible for their emotions to hijack their decision-making. Here's how. First, implement rules-based systems that remove discretion from your investment process. This is actually one of the hidden benefits of momentum strategies we discussed earlier. They provide clear, objective signals for when to buy and sell, eliminating the emotional guesswork that plagues most investors. When the rules say, rotate out of technology into utilities, you do it, regardless of what CNBC pundits are predicting or what your gut is telling you. The system makes the decision, not your emotional brain. Second, maintain a decision journal where you record not just what investment decisions you make, but why you're making them and how you feel at the time. Are you buying a stock because the momentum indicators are strong, or because you're excited about the company's story? Are you selling because your rules triggered an exit signal, or because you're anxious about a potential market correction? This practice creates awareness of your emotional state and helps you identify patterns in your decision-making. Over time, you'll spot your psychological weak points and strengthen your mental discipline. Third, create a personal investment policy statement, a written document that outlines your investment philosophy, goals, asset allocation targets, and most importantly, your rules for managing market volatility. This statement becomes your financial constitution, a document you can reference during times of market stress to keep yourself anchored to rational principles. Your policy statement might include commitments like, I will not sell equity positions during market corrections of less than 15 cents, or I will rebalance my portfolio only on the first day of each quarter, regardless of market conditions. By deciding these rules in advance, during calm periods, you protect yourself from making impulsive decisions during emotional market swings. As Dr. Crosby puts it, the first rule of that profitable investing is to get out of your own way. Understanding and managing your investment psychology isn't just about avoiding mistakes. It can actually add 3 to 5% to your annual returns. Over a typical investing lifetime, that psychological edge could translate into hundreds of thousands of additional dollars in your portfolio. Think about what that means. The difference between struggling in retirement versus living comfortably might not be finding a better stock picker or reducing your fees by 0.1%. It might simply be building systems that protect you from your own worst psychological tendencies. This is perhaps the most powerful insight in all of investing, that your biggest edge isn't some proprietary algorithm or inside information, but rather your ability to maintain emotional discipline when others are losing theirs. Warren Buffett didn't become one of the world's richest men because he's smarter than everyone else. He succeeded because he built systems that allowed him to be fearful when others are greedy, and greedy when others are fearful. The beauty of these psychological techniques is that they work regardless of market conditions or which specific investment strategy you choose. Whether you implement the momentum approach we've discussed or stick with a modified indexing strategy, controlling your emotional responses will dramatically improve your results. Your action plan: implementing Wall Street's secret strategy. Armed with your psychological toolkit, you're now ready for the million-dollar question. How do I actually start implementing these momentum strategies tomorrow? While Wall Street firms charge clients thousands for access to these techniques, I'm about to show you how to build a professional-grade momentum system using just a handful of ETFs and about 30 minutes of work each month. I know what you might be thinking. This sounds complicated. Do I need sophisticated algorithms or a finance degree to make this work? The beauty of momentum investing is that the underlying concept is surprisingly simple to implement. You don't need complex formulas or insider connections, just a straightforward system that converts these concepts into real portfolio decisions. Let's break down your 3 possible implementation paths. First, the DIY approach using widely available ETFs, perfect if you enjoy being hands-on with your investments. Second, using model portfolios that follow momentum strategies, which provides a blueprint without reinventing the wheel. And third, working with specialized advisors who focus exclusively on active management strategies like momentum. For most of you watching, the DIY approach offers the perfect balance of control and simplicity. Here's the exact 5-step sector momentum edge strategy you can implement starting tomorrow. Step 1. Calculate momentum signals for each market sector. Look at the average returns over multiple time frames, the past 3, 6, 9, and 12 months. This creates a more reliable signal than just looking at one period. Step 2. Rank all the sectors based on these momentum signals from strongest to weakest performance. This tells you which sectors have the strongest positive momentum. Step 3. Verify that your top-ranked sectors have positive absolute momentum. In plain English, make sure they're actually trending upward, not just falling less than other sectors. Step 4. Allocate your investment dollars equally among the top 3 sectors. This gives you focused exposure to the strongest parts of the market without putting all your eggs in one basket. Step 5. Implement clear exit rules. If a sector falls out of your top 3 rankings, or if its momentum dips below cash returns, it's time to sell and replace it with a stronger performer. This systematic approach removes emotion from the process and lets the market tell you where to invest rather than trying to predict where it's heading. For the practical implementation, you'll need specific ETFs that track different market sectors. The SPDR S&P 500 ETY gives you broad market exposure, while sector-specific ETFs let you target particular areas showing strong momentum. For tech exposure, consider the Invesco QQ Trust QQQ, which tracks the NASDAQ 100 index. For financial sector exposure, the Financial Select Sector SPDR Fund XLF is perfect, while the Technology Select Sector SPDR Fund XLT gives you focused tech exposure. These funds make it incredibly easy to implement sector rotation without having to pick individual stocks or time the market perfectly. And the best part? You can execute this entire strategy with the same low-cost broker you might already be using for your index funds. But how do you stay on top of momentum signals without becoming a full-time investor? You need resources for ongoing education and monitoring. Financial news platforms like CNBC and Bloomberg provide market trend insights, while specialized investment blogs cover momentum strategies in detail. For data-driven investors, websites like Morningstar and Seeking Alpha offer powerful tools to track sector performance and identify momentum shifts. If spreadsheets aren't your thing, tools like Portfolio Visualizer let you backtest momentum strategies and monitor current signals with just a few clicks. These resources make it possible to manage a sophisticated momentum strategy in just a few hours each month. Now, what if you already have a portfolio full of index funds? How do you transition without disrupting everything? The answer is to start gradually. Consider allocating 10 to 20% of your portfolio to momentum strategies initially. This lets you test the approach and get comfortable with the process without making dramatic changes all at once. As you gain confidence, you can increase the allocation based on your comfort level and results. This gradual approach also helps you avoid the psychological challenge of completely changing your investment approach overnight. A key component of successful momentum investing is maintaining discipline through market volatility. Create a simple checklist to follow religiously. 1. Identify sectors with strong recent performance using your momentum signals. 2. Use appropriate ETFs to gain exposure to these sectors. 3. Monitor performance regularly. Monthly is typically sufficient. 4. Adjust allocations based on your momentum signals without second guessing. 5. Utilize tools like Portfolio Visualizer to keep track of performance and signals. This disciplined approach is what separates successful momentum investors from those who jump in and out of the market based on headlines or emotions. Here's what makes this approach so powerful. You're not trying to predict the future. You're simply observing which sectors already have strong momentum and positioning your portfolio accordingly. The strategy adapts automatically to changing market conditions without requiring you to make forecasts about interest rates, economic growth, or geopolitical events. Remember that even the most sophisticated hedge funds using momentum strategies will have losing periods. The key is sticking to your system through both good and bad markets, knowing that the long-term edge is firmly in your favor. For investors who prefer a more hands-off approach, consider model portfolios that follow momentum strategies. These are often available through specialized advisors who focus exclusively on active management. These professionals can provide tailored strategies based on your individual risk tolerance and investment goals, though they typically charge higher fees than robo-advisors or traditional financial planners. The bottom line is that you can implement professional-grade momentum investing with just a few hours per month. No fancy algorithms, no Bloomberg terminals, no Wall Street connections required. Just a systematic approach to identifying market strength and the discipline to follow through consistently. Throughout this journey, we've uncovered something profound. That small improvement in your investment strategy isn't just a minor detail, it's potentially life-changing. Studies show that even a 1% increase in annual returns can translate to hundreds of thousands of dollars more at retirement. That's not just a statistic. It's the difference between struggling and thriving in your golden years. Look at the real-world examples we've examined. Investors like Richard Driehaus, who made early moves into companies like Apple and Home Depot, or Cathie Wood, with her strategic investments in Tesla and Zoom. They didn't have superpowers. They simply applied momentum principles consistently. This knowledge is your opportunity. The financial freedom that Wall Street professionals enjoy doesn't have to be exclusive to them. Every strategy we've covered represents a chance to take control of your financial future. Don't wait for permission. Your future self is counting on the decisions you make today. The extraordinary returns we've discussed